So interest rates and balance sheet size affect the price of money. And if you look in most markets, if we ask, are price controls good? Most of us would say no. Price controls are not historically effective. They're not theoretically effective. Markets should set prices. But in this kind of current era, we have price controls for the price of money, or specifically the price of credit. And so rather than letting the market kind of determine what is an appropriate price of credit, it's highly influenced by the central bank.
Financial analyst Lyn Alden delves into the intricate world of central banking, specifically focusing on the Federal Reserve's role in shaping the global economy. Alden highlights how interest rates and balance sheet size wield immense influence over the price of money, despite the traditional belief in market-driven pricing mechanisms. The Federal Reserve, essentially governed by a select group of 12 individuals, determines crucial aspects of the interest rate pricing system, impacting billions of people globally. Alden sheds light on the opacity of the Federal Reserve's decision-making process, likening it to an unelected but powerful fourth branch of government. She critiques the cyclical nature of their actions, where attempts to stimulate the economy often lead to unforeseen consequences, affecting both savers and debtors. As inflation and employment rates become focal points, the Federal Reserve faces a delicate balancing act, adjusting interest rates to manage economic stability. The key takeaway here lies in Alden's anticipation of future developments. She hints at the challenges the Federal Reserve might face in the coming years, especially regarding their balance sheet. The looming question of whether the Fed can continue reducing its balance sheet or face liquidity issues becomes a critical focal point. Stay tuned for the critical insights that lie ahead.
So they set short-term interest rates. Sometimes they even override long-term interest rates, like what Japan's doing now or what the US did back in World War II. But basically, various parts of the interest rate kind of pricing mechanism are heavily set by the centralized group, and it's literally 12 people that decide. It's 7 members of the board of governors, and then it's a revolving set of other central bank heads. And some of these are appointed. None of them are elected. And so it's almost like a council of elders deciding this is the price of money today. And then, they divine the tea leaves, and every 6 weeks, everybody tunes in to see what color smoke's going to come out of the group of 12 people sitting around the table decide. And that's one of those things that I think it's, when people look back in the future and see that this is how we manage money, this is how we manage literally the most important ledger in the world, which is the Federal Reserve. It's not only the base layer that we all use here in the United States, it's the ledger that almost every country ties into.
Right.
They own U.S. reserves as assets, and then also they have, on average, especially developing countries, they have a lot of dollar-denominated debt. So both their liabilities and their assets, to various degrees, are tied into this ledger. Domestically, we're tied into this ledger. So basically, hundreds of millions of people domestically, billions of people globally, and there are 12 people that can decide, should interest rates be 2%, 3%, 5%, 7%?
Yeah.
Should we expand the base layer of money? Should we do QE? Or should we decrease the base layer of money? And so it's kind of remarkable that that's the system we have today. Yeah, I would describe the central bank as the fourth branch of government here in the United States. And kind of the Supreme Court, like we don't elect the Supreme Court, but they are appointed. The Federal Reserve, at least a majority of the members, are appointed, but it's still in a very opaque process. The whole structure is something that people don't really understand for the most part.
Yeah.
And it's just so impactful. And for I think most other markets, we wouldn't really put up with price setting on a long-term basis, but that's what we have to do in money. And so, it's funny because they often, and this is one of the big criticisms of them from certain schools of economics, is that they're often putting out fires that they themselves started. So
Right.
They lower interest rates, they make liquidity available. People then go out and they build credit, they build debt, and then things get overheated. So they start tightening the monetary condition that breaks the debt that they previously enticed to happen.
Yeah.
And so they both devalue savers, but then they also sometimes go after debtors that they themselves encourage to get in debt. And right now, one of the big narratives is that one of their metrics for trying to get inflation down is they're trying to get unemployment a little higher.
Right.
So there's literally a part of the government, essentially, that is doing their best to slow down wage increases and create more slack in the labor market.
Right. Yeah.
But of course, that's a few years ago, they were rooting for the opposite, but they were debasing the money to do so. So there's multiple different stakeholders here. And at any given time, they might be in one of their camps or another camp. And we have to hope that these 12 people get it right. And I would say their track record is not strong. So I think the next couple of rate hikes are more in this pause type of time frame because they've gotten to the extent where, at least the way they measure it, they have positive real yields, even though the inflation metrics are not down to 2% target yet. And so, and they know, and they've said before, and it's true, that this comes with a lag. Their effects come with a lag. And one way, like a key mechanism for why that is that just because they raise interest rates doesn't mean that everybody's debt changes overnight.
Sure.
It doesn't really change until things have to be refinanced, things mature, things get refinanced. And so there's still a lot of weaker companies out there. So there's commercial real estate, there's junk rated companies with shorter duration debt. There's small businesses that rely on bank loans. These are pretty short duration types of liabilities. And all of that has to be refinanced in the next coming years at these higher rates. And so some of the downward pressure we've seen from the prior tightening has not necessarily impacted markets yet. And I think that now they're getting to a point where they're going to be more in that steady range. Maybe we'll get maybe we'll get another 25 basis points. We'll see if they're either on the every other meeting schedule, or they might even start slowing down more than that to kind of see what they've already done. And I think a more interesting question to watch is what's going to happen with their balance sheet, because if we do continue to see trouble in the long end of the curve, even though they don't directly set the price of the long end of the curve, unless they choose to do yield curve control, they do influence it by buying or selling long duration bonds. And right now, with quantitative tightening, they're effectively selling long duration bonds. They're letting them mature off their balance sheet. They're not reinvesting them. And if you do start to see liquidity problems in the treasury market, similar to 2019, when they had to stop their balance sheet reduction, you could see that again. Now, they do still have the very large reverse repo liquidity facility, but that's only good for funding T-bills. And so I don't think we're quite at that 2019 period yet where they're going to run out of room to keep reducing their balance sheet. But I do think we're in kind of the second half of this phase where maybe next year is when they get to a point where they're no longer able to keep drawing down their balance sheet. And then they either have to hold it steady for a while or start gradually increasing it again.
Lyn Alden provides a nuanced perspective on the current economic landscape. She anticipates a period of economic malaise and stagflation, where certain industries will face challenges while others muddle through. Alden emphasizes the importance of industry-specific analysis, highlighting sectors like real estate and small businesses that might experience hard landings. Interestingly, she hints at a future liquidity cycle around 2024 to 2025, suggesting that strategic investments, including assets like Bitcoin, could be opportune during that period. Alden's insights underscore the complexity of the financial terrain, urging viewers to consider a tailored approach in navigating the evolving market conditions. Let's continue the rest of the clip.
I'm more in the recession/stagflation camp. I think we're going to have some areas of still sticky inflation. I don't think economic indicators are going to be very strong in the next 6 months or so because, again, a lot of this debt is still, a lot of these higher rates are still trickling through the private sector. But I think one way to look at this is kind of like industry by industry. So if you're in an industry that's not very rate sensitive, right? So for example, investment grade corporations, they locked in a lot of long duration, low yield debt. And so they're not really impacted too heavily by these interest rates directly. Same thing for homeowners that locked in 30-year fixed rate mortgages. So there's certain areas of the market that are more resilient here in the US. There's also, if you're on the right side of these $1.6 trillion plus deficits, if you're getting, if you're a company that is making money mostly from, say, upper middle class senior citizens, for example, you're probably doing pretty well in this environment. And so I'm not really too concerned about some travel companies or some of these other types of entities. I think that we have to be very kind of industry specific. And when we look at the post-dot-com bubble recession, so like the 2001 type of recession, generally that was actually a pretty mild recession by most metrics. So GDP didn't go down very much. Unemployment only spiked a little bit compared to recessions around it. But you still had a lot of turbulence in financial markets. And so I generally view, I don't really see a gigantic unemployment spike ahead of us. I don't really see kind of this widespread disinflation, deflation, kind of major recession type of environment. But I do think we're going to be more of an economic malaise, a stagflationary malaise. And then certain industries I expect to have hard landings. I think we're already seeing signs of that. Things like commercial real estate, things like certain small businesses. That's where I think you get more of a hard landing. and other parts I think muddle through until we get to that 2024, 2025 next liquidity cycle, and then that's when you probably want to be long a lot of things, including things like Bitcoin.
Thank you for tuning in to this eye-opening analysis. We hope you found this discussion insightful and thought-provoking. Remember, understanding the complexities of the financial landscape is crucial in making informed decisions about your investments. If you appreciated the insights shared in this video, don't forget to hit the like button, subscribe to our channel, and click on the notification bell so you never miss an update. Share your thoughts and questions in the comments below. We love hearing from our viewers. Stay informed, stay vigilant, and most importantly, stay ahead in your financial journey. Until next time, take care and invest wisely.